Hi students, today our topic for discussion is solving problem in present value method, payback period method, annual rate of return method. Let me explain this question. Before explaining reading the question, I would like to explain what is meant by present value method. In case of present value method, what will you do? We will compare the present value of cash inflow with the present value of cash outflow. In continuation of present value method, profitability index method also will do. In case of profitability index method, the formula is present value of cash flow divided by present value of cash outflow. Here, given the question is, the initial investment of the project is 50,000. So the firm made an investment in a particular project 50,000. It generates cash inflow of 20,000, 15,000, 25,000, and $10,000 for the period of 4 years. Another important information given is 10% rate of discount. It is nothing but 10% cost of capital. The firm has to, what they have to do, it has to discount the rupee at 10% cost of capital. So we have to find out from the annuity table what is the value of the money at 10% cost of capital. It is identified that, so in the year of first year, the 1 rupee become 0.909. Second year, the value of 1 rupee become 0.826. Third year, it become 0.751. Then fourth year, 0.683. It means that at 10% cost of capital, the value of 1 rupee is discounted like this. So the present value of method, what we have to do, we wanted to find out the true value of the money. So here you just copy, here you just put all cash inflow, 20,000, 15,000, 25,000, 10,000. Then you are writing the discounted value of money for 1 rupee. So next thing, what you have to do, you want to find out what is the present value of 20,000 at the end of the first year. Multiply 20,000 into 0.909, you'll be getting 18,180. You multiply 15,000 into 0.8206, you are getting 12,390. So likewise, here also you multiply 25,000 into 0.751, 18,775. 10,000 into 0.863, you are getting 6,830. When you add up all these things, you are getting 56,175. So this is the total present value of money. But how much you have invested in this particular project? You have invested 50,000. Excuse me. So 50,000 you have invested. So what is the formula? Present value of cash inflow minus present value of cash outflow. So when you deduct 50,000 from 56,175, you are getting 6,175. This is the net present value. So in case of net present value, the formula is I just note down here, net present value method. In the formula is present value of cash inflow, present value of cash inflow minus present value of cash outflow. Just note down. So here I just copy here. Cash outflow. This is the formula. Net present value is equal to present value of cash inflow divided by present value of cash outflow. This is the formula. Then another thing you are asked to calculate profitability index method. Profitability of the proposed index. So profitability index method. Profitability index method is equal to, so here just the reciprocal of this, the relationship between that ratio between present value of cash inflow divided by, so just put cash outflow, that is you have to take present value. This is the formula. The profitability index method is equal to present value of cash inflow divided by present value of cash outflow. Cash outflow. So here in this problem, what is present value of cash inflow? You got 56,175. So you just put 56,175 divided by 50,000. That's right. You have to write 56,175 divided by 50,000. So you will get, this is your, but here what is it? Net present value method. 56 present value of cash inflow is equal to 56,175 minus 50,000. So you are getting 6,175. This is a your 175. It means that your present value of cash inflow is more than present value of cash outflow. So here 6,175, that is the answer. Then when you divided by cash inflow divided by cash outflow, you are getting 1.1235. 1.1235. So what is the meaning of it? Please understand here. Now the question rises whether we have to accept this proposal or not. In this case, cash inflow is more than cash outflow. We can accept the proposal. In case of profitability index method, in the accept, what is the acceptable criteria is, so what basis you will accept? When the value is more than 1. Yes, here your answer, that is the value is more than 1. So we can accept the proposal. Understand? This is the net present value method. Here again I repeat, all the cash inflow, your discounting factor, multiply both the things, you will get the present value of cash inflow. Then you deduct the cash inflow from the cash outflow. There is cash inflow minus cash outflow. In case of profitability index method, cash inflow divided by cash outflow. The value is more than 1, we can accept. So next question, we'll discuss about the here the question is, we need to evaluate two alternatives using the payback period method, average rate of return method, net present value method. So here we are going to discuss about three methods, how we are going to do the problem. I'll read out the question. A company is considering whether to purchase a new machine. There are two options are there, machine A and machine B. So each machine are available for $80,000 each. So the machine worth is 80,000. The earnings are given or after taxation are as follows. So the earnings are generated for the periods of 5 years. Earnings after taxation. So in case of machine A, first year 24,000, second year 32,000, third year 40,000, fourth year 24,000, fifth year 16,000. Similarly, in case of machine B, 8,000, 24,000, 32,000, 48,000, 32,000. So now you are asked to evaluate the two alternatives using the following payback period method. That is, payback period is one question. Second question is, you have to calculate the average rate of return method. Third question is, you have to calculate the net present value method. You should use discount rate 10%. Similar to previous problem, you are asked to calculate with a 10%. So payback period method, all the cash flow, you just put it. Here we have already discussed under the payback period session. When the cash inflows are uniform, you have to use the initial investment divided by average cash inflow. But as far as this question is concerned, the cash inflows are not uniform. So we have to calculate the cumulative cash flow. First, copy all the cash inflow. Let me explain the machine A. For machine A, I will calculate and show you. So you can do it for machine B. Machine A, first the cash flow, next calculate the cumulative cash flow. First 24,000. So cumulative for 24,000. 24,000 plus 32,000. So just to copy 3 plus 2, 5. So 6. 56,000. So actually how much money required? Our investment is 80,000. Okay, 50. So 50 up to say second year we are able to generate 56,000. We can move to third year, but if you add up the third year, your amount become cumulative cash flow become 96,000. 56,000 plus 40,000, 96,000. But we require only 80,000. So we have to stop second year itself. Then what you have to do? Second year, so 2 plus second year. Amount required is how much actually? 80,000 minus 56,000. So what is the actually initial investment? Just check it. 80,000. 80,000. Amount required 56,000. Divided by, so close the bracket, divided by But how much amount available? 40,000. So this will give 3.5. So 2 into this will give the answer of. So please do this calculation. 80,000 minus 56,000 divided by 40,000. So you will be getting the answer of 2 years 7.2 months. So that is the answer for your payback period method. Otherwise, we can do it this way also. Please listen. Here 24,000 plus 32,000 plus how much amount required. So this is the answer, payback period method. Likewise, you can do it for the machine B also. In case of machine B, first year 8,000 is the income. Second year 8 plus 24,000, they are adding it 24,000 plus 32,000. If you go beyond the third year, your value become more than the 80,000. So you are stopping the third year. Then you are calculating the proportion amount required. Like this, you have to do it. How much amount required? That is your 80,000. Then how much generated divided by the number of years. Next method is the. So this is the according to payback period method. Which case the shortest payback period? In case of machine A, your payback period is 2 divided by 2 into 3 by 5 years. But machine B, 3 years. 3 into 1 by 3 years. So it is advantageous, machine A is advantageous. So your machine A is more preferred. Next is the rate of return on investment method. Rate of return on investment method is, the formula is average cash inflow divided by investment. What is average cash inflow? You add up all the cash inflow. 24,000 plus 32,000 plus 40,000 plus 24,000 plus 16,000. It is related to 5 years. So here it is given that add up all these things, you are getting 1,36,000. So divided by 5, you are getting 27,000. In case of machine B, 1,44,000 divided by 5, you are getting 28,000. So now you have to calculate the annual depreciation. What is the formula of annual depreciation? How to calculate annual depreciation? Because cash flow you are getting minus depreciation. Then if you have any savings, you have to deduct it. Scrap or anything is given, you have to deduct it. Here it is given that, please listen, here clearly given that a company is considering whether to purchase new machine A and B available for 80,000. Okay, now we have to do annual depreciation. The formula is, I will write the formula. Cost of the machine. This is the straight line method of calculating depreciation. Depreciation. Depreciation is equal to cost of the machine divided by estimated life of the machine. Here, cost of the machine 80,000. Initial investment 80,000 divided by life of the machine is 5 years. So 5. So is equal to how much you are getting? 16,000. This is the depreciation. So here is an 80,000, 16,000, here also 16,000. Now what is your saving? Cash inflow minus depreciation. So 27,000 minus 16,000, you are getting 11,200. This is annual savings after depreciation. Similarly, here also, see, average cash inflow is 28,800 minus depreciation is 16,000. So you have to deduct the depreciation from the annual cash inflow. You will be getting 12,800. Now, what is your average investment? Average investment is investment divided by 2. That is, if you have opening investment at the beginning of the year and closing of the year, you don't have anything like that. So average investment, you can take it as 80,000 divided by 2. You are getting 40,000. Here also 80,000 divided by 40,000. So now the formula is annual net savings divided by average investment. This is the formula. So 11,200 is your annual net savings or profit after tax. So, but here tax nothing is given. So profit divided by average investment. So I will write the formula. This is the depreciation. Formula is average, that is the annual earnings divided by average investment into 100. This is the formula. So here you can see that project Mission A, 28%. Mission A 20%, 28%. Mission B you are getting Mission B ROA 32%. So here you can see that Mission B rate of return is higher than the Mission A. So as far as ARR method is concerned, you can accept Mission B because it generates more than the Mission A. So, but what we have seen in payback period method, as far as payback period method is given concerned, Mission A payback period is the shortest period, 2.3 by 5 years. So we have preferred Mission A. But as far as this method is concerned, Mission B is accepted because it generates more than the Mission A. Next, we move on to same problem, net present value method. Net present value method, it is given that 10% cost of capital. So we have already discussed that the value of 1 rupee become 0.909 at the end of the first year. The value of 1 rupee become 0.826 at the end of the second year. Then it become 0.751 at the end of the third year. Then 0.683 at the end of the fourth year. Then 0.621 at the end of the fifth year. So your value of the money is discounted. Cash inflow for Mission A is given 24,000, 32,000, 40,000, 24,000, 16,000. So altogether 1,36,000. But we should not consider 1,36,000 because we wanted to find out the true value, real value of the money. We are incorporating the time value of the money. In order to find out the time value of the money, we are applying the discounting principle. So present value of the money, you have to multiply with the discount factor for each cash inflow. When you discount with the cash inflow, you are getting the present cash inflow of 1,04,660. So here, what is your cash outflow? As far as this machine is concerned, in case of machine A, your cash outflow is 80,000, but your present value of cash inflow is 1,04,616. So the acceptance criteria for net present value is your present value of cash inflow should be more than the present value of cash outflow. Definitely in this case, your outflow, that is the inflow, is 1,04,616, but our outflow is 80,000. So the surplus cash inflow generated in this project is 24,616. So we can accept this proposal. Similarly, we have to calculate machine B also. Machine B cash inflow for 5 years are given: 8,000, 24,000, 32,000, 48,000, 32,000. So total value is 1,44,000. The present value of cash inflow is, now you have to multiply with the discount factor. So you are getting this value: 7,272, 19,824, 24,032, 32,784, 19,800. So total it comes around 1,03,784. So here, when you deduct it from the, that is your cash outflow, you are getting 23,784. So as far as net present value is concerned, machine A generate more than the machine B. That is, machine A cash inflow is 24,616, but machine B cash inflow is 23,780. So what is the, we can accept machine B when compared to the machine A. So this is about the net present value. So we have seen accounting rate of return method, net present value method, payback period method. Payback period method, what we have done, the cash here, we can just go through. Here, cumulative cash flow, we have calculated because the present cash and the cash inflows are not uniform. So we have calculated the cumulative cash flow. Then we have applied the formula. So the shortest payback period will be accepted. In case of accounting rate of return method, the formula what we have applied is annual average net earnings divided by average investment into 100. So machine A generated 28%, machine B, the highest return we have preferred. Then in case of net present value, what we have done, present value of cash inflow is compared with the present value of cash outflow. The project whose cash inflow is higher will be, higher is accepted. So in this case, what happened? The project A cash inflow is 24,616, that will be accepted. I think it's clear. Thank you, students.